There is no shortage of people who say investing is simple and easy. Well, investing can be simple, but it is definitely not easy. Like with getting six-pack abs, everyone knows what to do. Eat less, work out more, but the execution can be incredibly difficult. With investing, it's crucial to understand what exactly is difficult. That way you're in the best position to succeed. Grab a drink, take a seat, let's talk about it. What's up, y'all? I'm Brian. I'm sharing 3 things that make investing incredibly difficult and how to make each one easier. Similar to approaching somebody new, whether that's making a new friend or approaching a love interest. Like for me, whenever I approached my wife before we got married, it was incredibly difficult because of the fear of rejection. I don't know how she feels about me until I just put myself out there and approach her. It's the same way with investing. It's impossible to know how a stock investment is going to perform until you just do it and see how it goes. If I wanted guaranteed returns, I could put my money in a certificate of deposit or a United States Treasury bond, and I would be pretty sure I'm going to get my 3, 4, 5% unless the United States government goes under. But the stock market has averaged 10% annual returns over the last 100 years, making it one of the most powerful tools for protecting wealth and creating new wealth. However, the fear of uncertainty pushes a lot of would-be investors away and tricks existing investors into making the worst possible decision. There's nothing more difficult than continuing to invest in the stock market as it is crashing. And ironically, this is the best time to invest, when prices are down, when stocks are on sale. But whenever the stock market is crashing, everybody in the news and the media are screaming, there's blood in the streets and everything is going down to nothing. There is a lot of pressure on the outside to sell your investments and get out of the stock market, run for the hills. That's why Peter Lynch, one of the most famous investors of all time, says that the most important organ when it comes to investing is not your brain or your heart, it's your stomach. You've got to have the stomach to deal with uncertainty. You got to have the stomach to continue investing, not just hold your investments, but continue to investing during a market crash to be a successful investor. Investing during a market crash seems to go against our core instincts. It's almost like I'm being told to step off a cliff to keep investing when the market is plummeting. It reminds me of when my wife and I went rappelling, and that's exactly what we're doing. You know, of course, we're locked in, we've got our safety gear, and the instructor is like, okay, just back up off the cliff. And it is so difficult to take that step. Even when I know logically it's the right thing to do, the act of stepping off the cliff is so difficult. It's the same with investing. When I look at the market crash of 2020 during COVID, in hindsight, I can see, oh, it went down and up. It's a little blip. But whenever I scroll back and I look at how the market actually appeared during that time, it looks like a cliff. The market was at about $340 a share. And within a month, it crashed down to $230 a share. That's a 30% drop. And from that perspective, it looks like it's going to keep going down. People during that time were scared into selling their investments at the bottom. And then COVID had an incredibly fast recovery. In just 5 months, it's all the way back up to where it was. And some people are just now getting back into the market at that time when it's already recovered beyond the point of where they sold. The best way that I have found to deal with the fear of uncertainty is to automatically invest my money, a small amount every single week, into the stock market. If I set up my investments to automatically roll forward, I can trust in the process. I don't have to look at it, and I can have faith that the stock market is going to continue to return 10% per year on average, as long as I'm invested for 10, 20, 30 years at a time. And you would think if there's no excitement in the market, if there's no crash and recovery, then investing becomes incredibly easy. But that's not true either. I myself fall victim to this. It's easy to get bored when you're doing the same thing every single day, every single week, for years at a time. And it's not a fast process either. You know, I wouldn't get mad at a screwdriver because it's taking forever to hammer in the nail. I'm just simply using the wrong tool. Investing in the stock market is not a tool to make a lot of money really fast. If I'm a new investor and I'm starting by putting $50 a week in the stock market every week, after 2 years, I'm going to end up with about $6,000. Whereas if I put that same money in a savings account, I'd end up with about $5,300. So the difference is really not that big. But 2 years is a long time for somebody to get into something new and have faith in the process, and they get there and they haven't made amazing results. That's tough psychologically on new investors, especially if you're not getting average returns. $6,000 is assuming an average 10% return. Sometimes the stock market goes down. I might have lost money in those first 2 years, and then I would have a really hard time sticking with it beyond that. But in reality, that is how compounding works. The first few years are very slow, and then after 10, 20 years, it starts to really pick up. If I continue to invest $50 every week, after 20 years, I'd have about $163,000. Whereas if I put that same money in a savings account, I'd only have $58,000. It's nearly a 3 times difference for investing. At first, I didn't see that big difference, but then over time, it starts to grow more and more, and it only accelerates. The next 20 years, I add more than $1 million to my net worth. In the first 20 years, I get up to about 160,000. In the next 20 years, I get up to $2.25 million. I have found that the best way to combat boredom in investing is, once again, to just not pay attention to it at all. If I am making investing a big part of my life, there's just not that much that's going to happen. It's going to be the same thing week after week after week. And if I'm all about investing and looking at my returns every single day, it's going to be a recipe for burnout. The best case scenario is to set up automatic distributions, automatic investing, and just forget about it. Do other things with your time, not look at your returns. If you are really excited about investing like I am, I like to continue to look for new investments, but I do not look at my existing investments every day or even every week. So now that I'm consistently investing every week, is it better for me to pick my own stocks, or is it better for me to let someone or something do it for me? When I say something, it sounds like I'm referring to an investing creature or something, but I'm talking about robo-advisors and index funds. This would be passive investing, when I'm letting a formula or an AI pick my investments for me. Whereas an active investor is somebody who picks their own stocks or lets somebody else pick stocks. This is a little bit counterintuitive, but just because I'm letting someone invest for me doesn't mean I'm a passive investor. A passive strategy is where you're invested in the entire market and you're actually going after average returns. Whereas an active investor is trying to pick stocks with the purpose of getting above average returns. The most iconic and famous investing book of all time is The Intelligent Investor by Ben Graham, and many of the greatest active investors of all time were inspired by this book. Bill Ackman and Warren Buffett both talk about how this was a very formative book in their investing career. Well, Benjamin Graham talks about the spectrum of active and passive investors. He says that an active investor must spend a lot of time and have expertise and experience, and they are able to get above average returns. And the passive investor is able to get average returns. But anyone in the middle does worse. They actually get the worst of both worlds. And this happens when passive investors get bored over time. They start out passive and they start putting in a little bit of effort to try to be a little bit more active, but they're not active enough or skilled enough to get above average returns, so they end up with below average returns. Active investing is like designing and building your own custom furniture. It's unique, it can be very beautiful and well done, while passive investing is like buying furniture from IKEA. It's cheap and reliable and efficient, and you're gonna get a good product even if you're not a skilled woodworker. Now, if you are not a skilled woodworker and you're trying to build your own custom furniture, it's probably not going to turn out very good. Investing small amounts of money consistently over many years into cheap and passive index funds is incredibly hard to beat, even for professional active investors. But before you start investing in 2025, check out this video right here to see how to put yourself in the best position to succeed. Cheers.